Take a look at the American financial system right now, and you will see something that defies logic. It is an anomaly so large that it is almost impossible to comprehend without seeing the raw numbers. We are currently staring at a mountain of cash so massive that it threatens to reshape the global economy. Not over the next decade, but over the next 12 months. As of right now, there's approximately $7.6 trillion sitting in money market funds. That is cash. That is capital sitting on the sidelines, doing absolutely nothing. To put that number into perspective, that is roughly 25% of the entire United States GDP. It is more than the GDP of Germany and Japan combined. It is enough money to buy Amazon, Apple, and Microsoft outright, and still have trillions left over. We have not seen a cash pile this high relative to the economy since April of 2020, right in the heart of the pandemic panic. Before that, we saw it in January of 2009, the absolute bottom of the great financial crisis. And before that, we saw it in October of 2001, following the dot-com bubble burst and the geopolitical shock of the September 11th attacks. Notice the pattern. These mountains of cash always appear at moments of extreme historical stress. They mark the three largest economic downturns of the last 20 years. In every single one of those previous examples, that cash was accumulated because fear was rampant. Investors, institutions, and corporations were terrified, so they sold everything, stocks, bonds, real estate, and ran to the safety of the dollar. But today is different. The stock market is near all-time highs. Unemployment is relatively low. The media tells us the economy is strong. Yet, the cash pile is growing. It is getting bigger every single day. This creates a paradox that should keep every investor awake at night. If the economy is so strong, why is there $7.6 trillion hiding in the bunker? And more importantly, what happens when that money decides to come out? This is the $7 trillion question. When this dam breaks, it will trigger one of two specific scenarios. We call them Scenario A and Scenario B. One leads to a deflationary crash, where cash is king. The other leads to an inflationary melt-up that could destroy the value of the dollar itself. Most people are betting on Scenario A. But the data, the deep structural data, is screaming that we are actually walking blindly into Scenario B. And if you are not positioned for it, the wealth transfer that is coming will likely leave you behind. To understand why this is happening, we have to look at why that money is there in the first place. It is not an accident. It is a rational response to a very specific set of incentives created by the Federal Reserve. For the last 2 years, you could earn 5% interest, risk-free, just by holding cash. You did not have to buy stocks. You did not have to buy real estate. You did not have to start a business or hire employees. You just parked your money in a money market fund and got paid. This created a massive vacuum in the economy. It sucked liquidity out of the real economy and trapped it in the financial sector. Think about the corporate boardroom meetings happening all over America. CFOs and treasurers stopped investing in research and development because the hurdle rate, the return they needed to justify a project, became too high. Why build a new factory that might return 6%, with all the risks of construction delays and labor strikes, when you can get 5% from the government for doing absolutely nothing? This behavior starves the economy. It is like an engine running low on oil. The pistons start to grind. We see this in the manufacturing data, which has been in contraction for months. We see it in the real estate market, where transaction volumes have frozen, because nobody wants to sell a house with a 3% mortgage to buy one with a 7% mortgage. This is the classic setup for a recession. This is the argument for Scenario A. In Scenario A, the smart money, the hedge funds, the big banks, the billionaires, is sitting in cash because they know the engine is about to seize up. They are waiting for the crash. They are replicating the playbook from 2001 and 2008. They want to be liquid so that when the S&P 500 drops 30, 40, or 50%, they can step in and buy unmatched assets for pennies on the dollar. If Scenario A plays out, holding cash is the smartest thing you can do. You are essentially shorting the economy without taking any leverage. You are betting that the system will break, and you will be the one holding the only asset that matters: liquidity. For a long time, this was the consensus view. Everyone from major bank CEOs to YouTube financial gurus was predicting a hard landing. They pointed to the yield curve, which has been inverted for longer than at any point in history. They pointed to leading economic indicators like the Conference Board Leading Economic Index, which has been flashing red for 2 years straight. But there is a major problem with Scenario A. It relies on the Federal Reserve staying tight. It relies on interest rates staying high to crush that demand. And that is exactly what is changing right now. The Federal Reserve has started cutting interest rates. This is the game changer. The 5% risk-free return is disappearing. It is melting away. As rates fall, that $7.6 trillion starts to get very uncomfortable. If you're a fund manager holding billions in cash and your yield drops from 5% to 4% and then to 3%, you have a serious problem. Your clients expect returns. You cannot justify charging massive management fees for a 3% return when inflation is eating away at purchasing power. This forces you to move. You have to deploy that capital. You have to hunt for yield. This brings us to the terrifying potential of Scenario B. Scenario B is the melt-up. It is the scenario where the real economy slows down, but the stock market explodes higher. It sounds counterintuitive. It sounds wrong, but it has happened before. In fact, it happened during the most famous financial bubble in human history, the Roaring Twenties. Let us rewind to 1927. The United States economy was actually looking a bit shaky. The real estate market in Florida had already crashed in 1926. Manufacturing was slowing down. The agricultural sector was in a full-blown depression. In response to this weakness, and to help Great Britain return to the gold standard, the Federal Reserve decided to help. They cut interest rates. They flooded the system with cheap money. But instead of flowing into new factories or new farms, that cheap money flowed directly into the stock market. Why? Because the stock market was the only game in town that was moving. From 1927 to 1929, the U.S. stock market nearly doubled. It went parabolic. It was a vertical line up. This was not driven by fundamentals. Earnings were good, but they were not doubling. It was driven purely by liquidity. It was a monetary phenomenon. The cash that had been sitting on the sidelines was forced into the market by falling rates. It created a feedback loop. As stocks went up, people felt richer. As they felt richer, they borrowed more money, margin debt, to buy more stocks. The Federal Reserve had lost control. By the time they realized what was happening, it was too late. We are seeing almost the exact same setup today. The Fed is cutting rates to save a softening job market and to help the government manage its massive debt load. But the stock market is already at record highs. If just 10% of that $7.6 trillion decides to move into the S&P 500, that is $760 billion of buying pressure. That is enough to send the indices vertical. This is the nightmare of Scenario B. It is a crack-up boom. It is a situation where the currency is being debased, so asset prices fly upwards to compensate. It looks like a bull market, but it is actually an inflation event disguised as a rally. To really understand how dangerous this is, we need to look at the plumbing of the financial system. We need to talk about where this cash actually goes. This is the part that most mainstream news outlets ignore because it is complicated, but it is the key to the whole puzzle. Right now, a huge chunk of that $7 trillion is in what is called the reverse repo facility. This is essentially a checking account for big banks and money market funds at the Federal Reserve. For a long time, it was full to the brim, holding over $2 trillion by itself. It was dead money. As the Fed cuts rates and changes its balance sheet policy, that money is leaving the reverse repo facility. It has to go somewhere. Historically, when money leaves the Fed's safety, it buys treasury bills. This funds the U.S. government. But here's the catch. The U.S. government is currently running a deficit of nearly $2 trillion a year. They are spending money at an incredible rate. So follow the money. It flows from the money market funds, out of the reverse repo facility, into the government's coffers via treasury bills. And then the government spends it immediately into the real economy. They pay defense contractors, they pay healthcare providers, they pay government employees, they send out checks. This is a direct injection of liquidity. It is far more potent than the quantitative easing of the past. When the Fed did quantitative easing after 2008, they bought bonds from banks. The banks took that cash and just sat on it. It stayed in the financial system. But when the government spends, that money enters circulation. It buys goods and services. It increases the velocity of money. This is why inflation is proving so sticky. And this is why the stock market refuses to go down. We are flooding the system with liquidity at the exact moment supply is constrained. The government is essentially force-feeding the economy with cash, bypassing the banking system entirely. Now, add the AI narrative on top of this monetary fire hose. In the 1920s, the narrative was the radio and the automobile. It was new technology that promised to change the world. It captivated the public imagination. Today, it is artificial intelligence. Investors are looking at companies like Nvidia, Microsoft, and Google, and they are seeing the future. They are willing to pay any price because they believe the hype. They see a technological revolution that justifies infinite valuations. When you combine a powerful, world-changing narrative like AI with a flood of liquidity from falling rates and government spending, you get a bubble that defies gravity. You get a market that disconnects from reality. You might be asking, why is this a problem? If stocks go up, are we not all getting richer? The answer is no. Because in Scenario B, the price of everything else goes up too. If the dollar is being diluted to prop up the system, then the price of gold goes up. The price of oil goes up. The price of food goes up. Your stock portfolio might double, but if the cost of living triples, you are effectively poor. This is the generational shift we are talking about. It is a shift from a world where cash was a store of value to a world where cash is a melting ice cube. It is a shift from a world where you could save your way to wealth to a world where you have to speculate just to survive. There is another historical parallel we need to examine closely: the 1999 dot-com bubble. In 1998, the world was facing a massive crisis. The Russian ruble had collapsed. A massive hedge fund called Long-Term Capital Management blew up. It was a firm run by Nobel Prize winners, and it was leveraged to the hilt. When it collapsed, it threatened to take down Wall Street. The Federal Reserve panicked. They cut interest rates 3 times in rapid succession to ensure the system. They flooded the market with liquidity to prevent a crash. The economy was not actually in a recession yet, but the Fed added liquidity anyway. The result? The Nasdaq Composite Index exploded. It went up 85% in a single year. It was absolute mania. Taxi drivers were day trading. People were quitting their jobs to trade tech stocks, companies that had no profits, no revenue, and sometimes no product were valued at billions of dollars just because they had .com in their name. But here's the catch that everyone forgets. By early 2000, the liquidity dried up. The Fed realized they had gone too far. They saw inflation creeping up, and they started to tighten. The bubble burst. The Nasdaq fell roughly 80%. It took 15 years for the Nasdaq to recover to its previous highs. We are walking the same tightrope today. The Fed is cutting rates because they are worried about the job market. They are worried about commercial real estate. They are trying to engineer a soft landing. But the market is already pricing in perfection. The price-to-earnings ratios of the top tech stocks are stretched to levels we have rarely seen. They are priced for massive, uninterrupted growth. If that growth disappoints, or if inflation comes roaring back because of all this new money, the air pocket underneath us is massive. This is where the $7.6 trillion becomes a double-edged sword. In the bull case, scenario B, the cash floods in and pushes the market to dizzying heights for another 12 to 18 months. It creates a blow-off top that makes 1999 look tame. In the bear case, scenario A, the cash stays on the sidelines because the owners of that cash see something the retail investor does not. They see a cliff. So who owns this cash? That is the critical detail most people miss. We talk about cash on the sidelines as if it is one big pile, but it is not. A large portion of this money belongs to corporations, but not just any corporations. The distribution is incredibly lopsided. Companies like Apple, Google, and Berkshire Hathaway are holding record levels of cash. Warren Buffett, arguably the greatest investor of all time, is sitting on the largest cash pile in Berkshire Hathaway's history, over $300 billion. He is selling stocks, not buying them. He has been selling Bank of America. He has been selling Apple. When Warren Buffett holds cash, it is usually a sign that he sees no value in the market. He is content to earn his interest and wait. He is playing scenario A. He is waiting for the crash. He knows that when the tide goes out, he will be the only one with a swimming suit. On the other hand, retail investors are all in. They are chasing the rally. They are buying 0-day to expiration call options. They are borrowing on margin. They are terrified of missing out. This creates a dangerous divergence. The smart money is selling to the dumb money. The smart money is building a cash fortress, while the retail public is leveraging up to chase the highs. There's another reason why this cash pile is so critical, and it has to do with the zombie companies. This is the corporate debt wall. During the pandemic, when rates were at 0, companies borrowed trillions of dollars. They locked in low rates for 3, 4, or 5 years. It was free money. But those debts have maturity dates, and those dates are coming up. In 2025 and 2026, a massive wave of corporate debt, over $1.8 trillion, has to be refinanced. But now rates are much higher. Even with the Fed cutting, corporations will be refinancing debt that was at 2% into debt that is at 5 or 6%. This is a massive hit to profitability. For the zombie companies that do not make enough profit to cover their interest payments, this is a death sentence. Roughly 20% of the companies in the Russell 2000 index are considered zombies. They have been surviving on cheap debt. When they have to refinance at 6%, they will go bankrupt. The $7.6 trillion in money market funds acts as a buffer for the system, but it is not distributed equally. The big tech monopolies have all the cash. The small and mid-cap companies have all the debt. This suggests that the generational shift will also be a consolidation of power. The big will get bigger. They will use their cash hoards to buy up their bankrupt competitors for pennies on the dollar. We saw this in 2008 when JP Morgan bought Bear Stearns, and we will see it again. If you are invested in the broad market, you are exposed to this risk. The S&P 500 is weighted heavily towards the winners, which masks the carnage happening beneath the surface. But if the bottom falls out of the economy, even the winners will eventually get dragged down. This reinforces the scenario B thesis in the short term, but confirms the scenario A thesis in the long term. Here is how that plays out specifically. Phase 1. The Fed cuts rates. The big companies with cash piles feel even richer. Their stock prices soar. The market melts up. The dollar weakens. This is the phase we are entering now. Phase 2. The debt wall hits the smaller companies. Bankruptcies start to rise in the retail, industrial, and real estate sectors. Unemployment ticks up. The economy weakens from the bottom up. Phase 3. The bubble bursts. The liquidity that drove the market up evaporates as fear returns. The market crashes. The $7.6 trillion on the sidelines is the fuel for Phase 1, the melt-up. But it is also the only life raft for Phase 3, the crash. So, what do you do? If cash is trash in an inflation boom, but cash is king in a deflationary crash, how do you position your portfolio? The answer lies in diversification, but not the kind your financial advisor talks about. The traditional 60-40 portfolio of stocks and bonds is in a dangerous spot. If inflation returns, bonds get crushed because yields rise. If the economy crashes, stocks get crushed. You need to look at what the central banks are doing, not what they are saying. Look at the price of gold. Central banks around the world, specifically China, Russia, and India, are buying gold at a record pace. They are dumping U.S. treasuries and buying hard assets. They are hedging against the devaluation of the dollar. They know that the only way the U.S. government can pay its debt is by printing more money. Gold acts as insurance against scenario B. If we get a melt-up and inflation runs hot, gold tends to perform well. It is the ultimate store of value when faith in the currency declines. On the other hand, you need liquidity. You cannot be 100% invested in volatile assets. You need to have some dry powder, some cash, to take advantage of the opportunities if scenario A plays out. But instead of just holding cash in a bank account that pays nothing, you have to be smart about it. Short-term treasuries or high-yield money market funds are still paying decent rates. You are getting paid to wait. The key is agility. The market is moving faster than ever before. Algorithms and AI trading bots react to news in milliseconds. The days of buying and holding for 30 years might be over for a while. We are entering a trader's market. You need to be active. You need to be paying attention. You also need to watch the generational shift in technology. The AI revolution is real, but like the internet in 1999, most of the companies claiming to be AI plays will go to zero. You have to separate the infrastructure builders, the companies making the chips, the energy grids, and the data centers from the hype merchants who are just slapping an AI label on a failing business model. We are living through a historical anomaly. We have never seen a Fed cutting rates with stocks at all-time highs and unemployment this low. We have never seen a $7.6 trillion cash pile sitting on the sidelines. We have never seen a government deficit this large during peacetime. This is a loaded gun. If the trigger is pulled and that money floods the market, we could see the S&P 500 hit dizzying new highs in a frantic inflationary blow-off top. That is the scenario B melt-up. It will feel good for a moment. Everyone will feel like a genius. Your 401k will look amazing. But if the trigger jams, if fear takes over and that money stays in the bunker, then the liquidity dries up, the debt wall hits, and we roll over into the recession that everyone has been predicting for 3 years. That is scenario A. The most dangerous thing you can do right now is assume that the future will look like the past. The rules have changed. The numbers have changed. And the stakes have never been higher. You have to be watching the data. You have to be watching the flows of funds. And you have to be ready to pivot. Don't let this $7.6 trillion shock catch you sleeping. The shift is already beginning. Thanks for watching.